Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to be here, Jeff.
Well, September is upon us, the last month of Q3. What are your expectations for September, Bob?
Well, I really like that the S&P closed above 3,500 on a monthly basis. Technical analysts tend to look at the longer time frames as being more significant. Let's see if we can get it to close on a quarterly basis above 3,500.
I like that. And that's one of the topics I really want to drill down on, that historic monthly close for the S&P 500. But I also want to talk about gold, shining again as it's tucking its head above 2,000. So let's get into these two topics. Are you ready, Bob?
Let's do both.
Well, the S&P 500, after a 5-month consecutive gain, we saw it close above 3,500 for the month of August. We have seen 26 times since 1950 a period of 5 consecutive gains. After that, the subsequent 12 months or the 1 year afterwards, the market has always been higher. But where do we go from here? We have a presidential election. We have a lot on the horizon, Bob.
Yeah, I think fiscal stimulus is the most important thing short term. Nothing going on right now. It's very pessimistic, but as we've seen with government closings in the past, oftentimes they take it down to the wire and they get something done. So I'm optimistic.
All right, that's a great point. And I get excited about the micro E-mini options on the S&P 500. They just launched this week. What type of risk mitigation trade example could you potentially utilize these micro E-mini options? And remember, the micro E-mini options are 1/10 the size, just like the micro E-mini futures. They're 1/10 the size of the futures, is also 1/10 the size of the options.
Well, I'm very optimistic about this product as well. Again, it allows you to dial down to detail and put on risk mitigation strategies in smaller size so you can remain bullish and potentially take care of the risks. And if you remember, the NASDAQ, when it got it to a new all-time high, it sold off a little bit. It wasn't a bear market. It wasn't even a correction, but it did come down a little bit. So I'd like to look at selling what's called a risk reversal. That's selling a 35.50 call and simultaneously buying the 33.50 put. And the underlying for this is the September contract. But again, we're doing the micro options. This is the week 2 option, and I'm going to collect about 56.50 on that spread.
And the E-mini S&P 500 was trading around 35.10. But that is the beauty of these micro E-mini options. You can express a bullish or bearish view, and you can define your risk. Just like using the larger option, this is 1/10 the size for the micro. So we get super excited about this, and we're going to see a lot of traction specifically in these products.
Now, slightly elevated volatility, which is why that put is holding so much value, but it does expire Friday, September 11th.
Well, that's a great point. We talk a lot about where the option premium is, and it certainly is elevated. Let's shift gears. I want to talk a little about gold, Bob. We've seen the U.S. dollar break below its 200-day moving average, and once again, gold is vaulting higher. So I guess my question to you is, are precious metals here to stay? Are we going to see additional new all-time highs in the month of September?
Yeah, over the last 11 sessions, the dollar index has been down 10 of those 11 sessions. And that's really been a little bit of a tailwind for gold. Traditionally, there's an inverse relationship between the dollar and gold. We saw the euro up above 120 for the first time in about 2 years. So I think gold could potentially have a little bit of a tailwind.
Well, my trade example does tuck in nicely. I'm looking to sell a put spread here, Bob. The week 2 September, just like you highlighted, that Friday expiration of September 11th. But I want to be a seller of the 1950-1900 put spread. That's going to be selling the 1950 put and buying the 1900 put. I'm going to collect a whopping $1,050 for this. The underlying futures was trading around 1976, but this is where you have the ability to express a view, a bullish view, but also collected an elevated premium. Do you know where that volatility was on that, Bob?
Well, it was elevated again on the gold volatility. I haven't looked at it this morning, but I do really like the lower strike of that trade that you've proposed, that trade example, simply because the 50-day moving average for the gold contract is right around 1950. So you've got some good support there.
For sure. And I just pulled up the volatility. It's actually at 20.38, higher than historically usual. So great stuff, but it is very interesting and important to understand when we talk on striking options about collecting premium, selling premium, defining what you're buying in premium. And that's all due to where the volatility is actually at, right, Bob?
Yeah, it's a solid strategy and elevated volatility, but you got to keep an eye on volatility in its current sort of like a week to 10-day horizon.
All right, Bob. Well, thanks as always. We also want to thank you for tuning in to Striking Options. Please tune in every week as we'll continue to strike options.